DealBox. I'm the CEO at this company. I stepped into this role in January of this year. Prior to this, I guess just a little bit of background on myself. I started my career in professional financial services about 9 years ago now. I was a derivatives trader first in the futures trading space. Metals and energies was my specialty. And then from there, I moved on to alternative investment deployment into private portfolio construction for both retail and institutional implementations. So I ran a lot of diligence on managed futures products, commodity trading advisors, hedge funds, PE, all of that great stuff. Spent a lot of time educating advisors on how the impact of alternative investment applications in portfolios actually changes the return profiles, the risk profiles, all of those analytical measures of how people think about constructing portfolios. And after that, I quickly realized that that world is more of an asset gathering business than it is an asset management business. I am not a salesperson, I'm a math and science guy. So I went on to run as Director of Operations a actively traded ETF tactical management strategy that we sold via separately managed accounts to a bunch of the big investment banks, and created our own mutual fund during that time, a couple hedge fund products. So, you know, I've kind of spanned the gambit in all of asset management in one way or another. And in a lot of ways, what we've been talking about here this week, and when people talk about digital assets and digital securities and cryptocurrency, you're just talking about another alternative investment. And so it's a very easy thing for somebody who has a background like myself, or if you've been in that industry before, to just take a lot of that same language and carry it over into how you talk about these things today. And so I'm going to spend a little bit of time talking about portfolio construction at large, and then we'll start to look at what secondary liquidity improvements can start to do from an impact perspective on the portfolios themselves. Again, just going back to my early financial advisor days, it was really difficult being an active manager from 2014 to 2016 at that time, because, you know, beta-based products, so, you know, those types of passively managed mutual funds and strategies, with the market basically just being in a straight line up and to the right for the last, 14 years now almost, it was very difficult for firms like us to compete. So like at our peak, we're about 600 million in AUM, and literally in a matter of 8 months, we went from 600 to 385, because that's how quickly people were getting out of active management and were convinced that, you know, passive management was the solution to this asset allocation equation. And as a matter of fact, I was in Santa Monica at a little fund called Dimensional Fund Advisors. Most people don't know about DFA because they are a $1 trillion asset management company that has a marketing budget of $0. If you're an investor and you use a financial advisor, there's probably about a 40% chance you own some Dimensional products, and you will have never heard their name. You will never hear their name. They have no plans on changing that. The gentleman who sits on the board is David Booth from Chicago Business, and he actually wound up joining that company because he was a student of Eugene, the father of the efficient market hypothesis. And so their headquarters is in Santa Monica, California, which is where I'm from originally, in that area of Los Angeles. And I'm sitting about from where Me to Mark is, listening to Eugene talk about this stuff in person. And I asked him a simple question. I said, Eugene, what happens in a world of passive management if the United States stock indexes start looking like the Japanese Nikkei from 1989 to 2000? I think it was, it took to 2019. So 30, for those of you who don't know, the Nikkei did not make a new all-time high for 30 years, and inflation adjusted, it is still down, which means that if you invested in Japanese stocks 30 plus years ago, you have lost money. That is spectacular. And imagine a situation where that happens in the United States. And Eugene's response was this: if you don't have 30 years on your time horizon to invest, you shouldn't own a single stock. Right, most people do. But what's ironic is that the average financial advisor is 62 years old and their average client is 70. Last I checked, life expectancy in the States is not 100 years old. So a lot of this was my kind of foray into coming in, leaving asset management and coming to join DealBox on an entrepreneurial journey, because at the start of this, it was about the technology, it was about blockchain, but it was about changing the perception of how portfolios are constructed. And again, just with my background in alts, this was a natural application for those things. So I've been talking about, let's see. some of this stuff, but just as a review, and apologies for the lack of design, my chief of strategy is no longer here, so this is my bulleted CEO pitch deck here. The world of asset management is becoming completely commoditized, and robo-AUM, so non-financial advisor-based asset management, is expected to pass $5 trillion in the next 4 years. So what effectively that means is that people are just signing up for an account on Grok or Schwab or something like that, answering questions. Here's your portfolio. Send us some money for you. It's single. Traditional asset management is only valuable for preserving wealth, not creating it. Again, back to these passively managed things and the way that central banks of the world have effectively commoditized asset prices, programmed the returns into these things, effectively to fit actuarial tables and retirement and pension payouts over time. That's really what's going on here. In terms of central bank innovation, that and systemic risk, of course. But again, this is the big thing. There's no alpha for 99% of investors in today's public securities markets. So if you're already wealthy and you're just trying to preserve your wealth and pass it on for generations, that's fine. But if you're looking to grow, you're likely not going to get it. And this is, I did not see this coming 10 years ago. Fixed income, I was speaking with a large multifamily office who's actually in attendance here today. If we're lucky, he might join us to the end. I asked him to come say a few words. But they said to me in their office, they manage $8 billion for 15 families, and they said to me in their office last week, literally fixed income is a dead asset class, we don't invest in it. Think about that. And so as a result, right, asset managers are struggling more and more to justify their fees and enhance their value propositions. This is for everybody that operates in this industry. Tara, you talked about this, right? This is the pitch, essentially, to the traditional finance world. Why does this stuff matter? Why do I care? Well, because if you don't reinvent yourself, you're dead in the water because of all of these things and probably about 50 more bullets if they would fit. Okay, so professional managers allocated. The Yale endowment portfolio is the most successful endowment on earth. The last 20-year return profile, both risk-adjusted and nominally and real returns, have outperformed every single other endowment on the planet. The most interesting thing is this purple graph here, which is their venture capital allocations. And you can see, since 1990 to today, how much this has changed. By about a factor of 4, right? You're looking at a multi-billion dollar, multi-generational asset manager that is effectively 50% allocated to alternative investments. 50%. The average American in portfolios today is somewhere around 5 to 6. Oops. All right. This is a really cool case study kind of from this year. So Tiger Global, one of the largest professional management companies, hedge funds traditionally, they have never in their history of about 30 years allocated to anything in venture capital or private equity. They strictly stuck to trading stocks and bonds and all of these fixed income, the normal asset classes. Well, check this out from this year. Firm has invested in 118 companies this year alone, and they've never done this before. Up 10x compared to its investing pace in the first 5 months of 2020. This is from, I think, June or July of this year, so relatively recent. What's interesting, $10 billion participating rounds totaled for further 11.5. This is a company that's never even moved into this space before, and they're thinking about these things like the Yale endowment model. They're thinking about what we're talking about, and they're not waiting. They're not doing so by, oh, let's test this. They're going full speed ahead because they realize this alpha generation problem is very real, and it's here today, and it's only going to get worse as monetary policy continues to expand. So, how should modern portfolios be allocated today? This is a sample, actually, from a real life portfolio of a family office that I advise from time to time. You can see in here a typical 5% cash sleeve, that's pretty normal. 25% fixed income, that number is usually 30 to 60 depending on the investor's age. Public equities, that number is usually 60 to 90, that's 30. Alts, 12. Real assets, 15, private placements, 13. That is what's really interesting here. We've been talking about this whole ecosystem of how to revolutionize the life cycle of private placements, which is why if some of you guys were here on Tuesday, I thought it was really cool how Dave and team set up the schedule for the day, because it started with myself coming up and talking about investment packaging and the actual construction of these private placements, and then all the way through this entire life cycle. Doing this 13% allocation to private placements is a lot of portfolios like this, and I spend a lot of time speaking across, frankly, the world. I gave this presentation in Brazil in 2019, and people were floored. People are not thinking about this, and when you think about the fact of how much capital is invested like this, a 1% move in any of these sleeves represents literally trillions of dollars across the globe. Just a 1% move. So getting people to see more clearly, just by way of example, this whole section, these 3 sections, is what I would consider to be alts at large. So the real assets, whatever they describe at the family office as an alternative, and private placements. And what are they at? 37, 40%? 40% alts. So I was kind of going to ask you guys, do you guys, does anybody work with a financial advisor? You do? Wow. See, normally I get a lot more hands on that. And that's part of the thing I was saying, right? Is that these people are basically being, subscribed away, pushed away by all this technology. There's how many people in here? 10 of us? And you're the only one who raised your hand. Not that that's a bad thing. I'm not saying you out. It's just interesting, right? Because that's a pretty normal thing to say. So is everybody fairly confident? Like if I were to ask you, obviously I don't need to know like numbers and things, but if I were to ask you this down for me on a piece of paper in these asset classes, do you think you could do it? Pretty close. Tara's like, yeah, pretty close. You too? So, most people kind of do. They think about it. These 3 things for me, I'm a little younger, so I'm a little more aggressive. These 3 things for me are 80%. Thank you.
That's how I did it when I was your age.
Good for you. Look, a pioneer. And I'm sure it's paid dividends for a long time, right?
Yeah.
That's great. Okay. So this is a lot of what we've been talking about this week, and I'm kind of going to bring it full circle here. So how can digital assets improve the investment landscape? Certainty of ownership. If you guys caught Dave's panel just now, up there with Joe and Gautam, talking about digital transfer agents and the likes of Vertalo, and being able to, over generations, digitally record the trade and transfer of these assets in non-certificated digital form, is one of the most important things from a multi-generational planning standpoint, especially when you think about the family offices and large asset managers. Investing is meant to be for the future. We're not talking speculating, I'm talking investing, big difference. Programmable capital structures. This is something the folks at Vertalo and I speak about a lot, is being able to know with certainty the exact amount of shares that are available to be issued, i.e. if for whatever reason somebody over allocates to a specific round or class, they should not have done so. This will force them from actually being able to. It basically generates an error and says, hey, this doesn't compute with the capital structure. That doesn't exist today. People overissue things all the time. I'm kind of speaking about digital transfer agents, efficient transfer functions. So things like estate settlement, probate, secondaries. Heard Dave talk about his inheritance of stock certs of Norfolk from probably 60 years ago, right? I've seen that stuff from clients of mine in the past with grandparents that had passed away, and they did show up to our offices with paper share certificates, and it took me months on the phone faxing paperwork to get these things moved over. It's just inefficient. We all know these things. Expedited liquidity horizons. This is really interesting. A friend of mine who lives here in town, actually, I was hoping he'd come join us today. He manages a real asset portfolio for the University of Texas's endowment. It's just a small sleeve at $65 billion. And he's an advisor to the business. And when I was telling him about this stuff when I was in town back in January, he said something really interesting to me, which I hadn't considered yet, as we were talking about ATSs. And he said, as I think about this, I'm starting to realize that there's a major impact on what's referred to as the illiquidity premia in venture investing. And his name is Matt, and Matt's probably one of the most intelligent people I've ever met in my life. Obviously, if you're managing an endowment, you're expected to be. And we've spent some time now talking about this. I know we have a guest from an ATS in the room, right? So I'm sure you guys spend a lot of time working this stuff into how you communicate with issuers and things like that. Architected exits. This is interesting from a fund management perspective. So we actually have a fund manager sitting in this room, and I work on a series of venture funds actually outside of DealBox with some personal capital of mine and some other friends that I like to invest with. And things into the mandates and the framework around the fund is being able to leverage DealBox's ecosystem and all the wonderful partners like you guys to do this for our fund investments. And basically what we do when we speak to potential portfolio companies is we say, listen, we're willing to take a position of this size, but rather than negotiate with you on terms and grind you down into all of these different negotiations around the investment, what we want to be able to do is say, hey, we want to know that you're willing to work with us on your exit strategy. And then we start basically reverse selling them, if you will, on this entire process, right? And that benefits the fund, it benefits the LPs, and it benefits pretty much everybody sitting in this room. And we think that's a good way to kind of think about it in reverse. So I spend some of my time talking to other fund managers, other family offices about this idea of architecting exits. Lower liquidity costs. You guys hopefully Noreen on Wednesday, right? She's been running public companies for 40 years, and I'll ask anyone who has a publicly traded company, if you're comfortable sharing with me, what do you spend on an annual basis to maintain these things? And I'll tell you, the cheapest you can do it for is probably $250,000 a year, but most of the time people are, and this is in the States, it's a little cheaper in Canada, but most of the time you're gonna be $500,000 to $750,000 a year. Annually in maintenance costs, compliance costs, filing costs, all of that stuff. And so when I think about the ATS environment, I'm really interested in just getting people to move, right? Because I asked the panel yesterday, you're kind of in this chicken and egg scenario, right? Quality issues versus market density. And at the end of the day, we just need really good businesses and really good operating companies like ourselves to just push the volume and start moving. It's time to go. The tech is here, the regulation is here. You're seeing it all culminated in this conference. There's no more time to waste. So in that instance, when we think about what the economics of these things look like, almost as an industry, we basically tell people, yeah, these are all the reasons things are better, and by the way, taking advantage of what's referred to as attention-induced trading and returns. This is a little bit of a taboo topic, but this is essentially the Wall Street Bets community, Reddit, meme stock, whole thing going on. And what's interesting is when you have an ATS that doesn't have thousands of issues trading on a daily basis, you can give more special attention to those issuers, both in the priming of prior listing, during the listing, during the trading of that asset. So one of the things that's really cool for issuers today is to be able to share this with them and say, listen, not only is this all of the reasons, but on top of that, you're not just another number in the books. You mean something to this community. You mean something to this ecosystem, and you get taken care of accordingly. There is tremendous human capital in this industry. It's sitting in this room. It's sitting in this hotel. Anybody else that comes from another industry that isn't familiar with this and they see and hear from all of you folks and they're listening to these conversations and they're meeting with people, it's amazing. It was not like this the last time I went to a life insurance conference, I'll tell you that. No offense if you're in the life insurance business. And then of course, real-time settlement. I mean, this is obviously the big thing. Folks at T0 talked about it. INX knows about this. John knows about this. But for the most part, this idea of settlement just allows things to move around a lot smoother. It allows you to rebalance and reallocate faster. And for the purposes of if there's any emergency situations, that's always a good deal. I used to get calls from clients all the time saying, oh my gosh, like we had this tuition bill and we weren't paying attention to it and it's $100,000, can you sell us some stock? And I go, yeah, I'll sell it for you right now, but I can't move it to you till Friday or Monday the next week, It's just more of a function of convenience, really. There's not too much on the technological side or like an advantage from like arbitrage or a trading perspective, but it makes life easier for asset managers mostly. Okay, on the issuer side. And most of these are just reiterations at this point. So real-time cap table analytics, effective investor relations. This one's really cool. You think about the lighter reporting requirements that are included in like an ATS environment, for example. And for the most part, you're seeing quarterly updates basically mandated, but single documents, a disclosure document here or there. But being able to utilize a system like say Vertalo, for example, or any of the ATSs that can work with a firm like ours, for example, to produce these documents for them at a cheaper cost than their attorneys do or their auditors do or those things, and basically streamline the entire IR function. This is one of the things that the SEC is the hardest about, right? Like, and I spoke about this on Tuesday. It exists to protect investors, and at the end of the day, they want two things. They want proper disclosures and make sure that you're not doing something that you said you weren't going to do. It really is that simple. And if you disclose all of this stuff, you can effectively do whatever you want as long as you say it and it's not illegal. That's it. So it's all about just getting into that effective IR capacity. And it's actually something we need to work on as an industry too, by the way. This is totally an iterative conversation at this point. Like, maybe we can talk about this later. But how do you streamline the ongoing compliance needs of those issuers that are trading on the systems themselves? Talent acquisition and retention. This is a shameless pull from the Carta website. You go there and you listen to some of their employees. It's really cool because Carta hosted the very first auction on their Carta Cross platform in January of this year. Effectively what they did is they opened up secondary trading for their employees and early stage investors. And they said to them, we're going to put a floor on the pricing or the valuation of these shares at basically the last 409A valuation, and we're going to put a ceiling that is 5 times the valuation of our preferred round. Half of the shares that they were wanting to sell before they hit that cap on the up had to freeze the auction, reprice everything, and batch the second. That's how much people are looking at this liquidity. That's how much demand there is for this stuff. And the employees that were interviewed afterwards, not the investors, because people don't want to, okay, great, everybody made money, but tell us about like your team. These people were like, we were able to buy our first house, we were able to put our kids through school, we reinvested in other strategies, we did things for our parents, we did things for our loved ones. And then the coolest part is we didn't just feel like employees, we felt like real owners. This is about giving power back to people, which is a little bit of the ethos of the early blockchain days too, right? Is power back to the people. The average Silicon Valley employee is 35 years old, has $10,000 in their bank account, and $2 million in stock on their balance sheet, but it is inaccessible. So anyways, talent acquisition and retention, we know the market that we're in. It's happening. You guys are reading articles about it right now, right? The government is stimulating away so much of employment that nobody wants to work in retail anymore. Nobody wants to work in the restaurant industry anymore. They want to go work for good businesses, but they also don't like working for major corporations. The exodus out of Wall Street is amazing. It's amazing what's happening. And so to the point where you have a business that is set up to take advantage of these type of liquidity solutions, and you put this in front of somebody as a benefits package for hiring, you're a rock star. They've never seen things like this before in a proposal to come work for someone. We already talked about expedited liquidity horizons and this one, so those are repeats. So yeah, I mean, in summary, a lot of this stuff is all inclusive, from the investors to the issuers to the companies to employment, you name it. You guys are all familiar with this. We've been here all week talking about it, so I'm going to stop talking.